Hello. In this video, we're going to look at corporate tax complete liquidations. Now, whenever we have to deal with corporate taxation, remember that it helps tremendously to look at where we are in the life cycle of the corporation. We started in other videos talking about corporate formation and contribution. We also talked about capital financing, specifically debt versus equity issues. Then we talked about normal operations, distributions and redemptions, which happen during the normal operations of the business. Finally, when the corporation is going to wind up operations, if they do, we have complete liquidations. Now, it's important to note that complete liquidations are not the same topic as partial liquidation redemptions or a normal distribution that happens during the normal operations of the business. So this checklist is meant to help you go through the consequences of a complete corporate liquidation. So the first question, do we actually have a Section 346 complete liquidation? So this is something defined under the tax law in Section 346 and under the regulations, okay? So you need to make sure you specifically have a complete liquidation. Now, if you're taking me for a class, I'm going to make it specific whether it's a complete liquidation or not, but you might have another teacher where you have to figure this out. Of course, in practice, it's very important. We look at the regs, the revenue rulings, whatnot. Just note that unless you have a complete liquidation, you do not, only when you have complete liquidation do you apply these checklists, these specific rules for liquidations. So the second question is, once we have a complete liquidation, is there a formal plan stating the corporation's plan to liquidate, including distributing property? If so, that has to do with the complete liquidation plan and how the distributions as a result of liquidation, how they play out, which is going to have an effect on the corporate and the shareholders in determining tax consequences. Next, is a shareholder a corporation or individual? The reason why that's important is because you're going to see that we have two complete liquidation sets of checklists. We have the general rule, and then we have the special subsidiary liquidation non-recognition rule. We'll talk more about that, but just note that if you have a corporate shareholder, you might be able to get that special rule, non-recognition. 4, if the transaction qualifies as a complete liquidation. So again, we talked about if it's not a complete liquidation, you don't apply these checklists. If it does, we continue with the checklist that you're going to see below. Again, the two sets. If it's not a complete liquidation, but there's a distribution, then we're going to look at the distribution checklist under Section 301, or if it's a redemption, we look at Section 302 checklist for redemptions. But again, these checklists focus on complete liquidation. The corporation has a plan in place, and under Section 346 will be liquidating. Okay, so once we've determined we have a complete liquidation, we now are going to look at the two sets of checklists. When we're looking at the checklists, it's important to remember we're going to focus on the corporate consequences, or the corporation's consequences, and the shareholder's consequences. Let's start with the general rule. So this is the general rule, and within the general rule, we're going to look at the shareholder first, okay? So we're looking at the consequences of the shareholder under the general rule. The first thing is, how much gain or loss does the shareholder realize and recognize? So under Section 331, what we're going to do is we're going to apply the normal Section 1001 amount realized minus adjusted basis. The amount realized is the amount that the shareholder is receiving using the normal amount realized formula, right? Actual cash received plus constructive cash received plus non-cash property minus selling expenses. The adjusted basis, this is important, is going to be the adjusted basis in the stock that shareholder has in the corporation. That's important. That's where some students, when they're learning this topic or in practice, got to keep straight. That's where things get kind of confusing, because you're going to see when we look at the consequences of the corporation, we use the adjusted basis of the property being distributed with respect to the corporation. Okay, so that gives us the realized and recognized gain or loss. Under the general rule, there's no non-recognition, so the realized gain or loss will be recognized. Second question, what's the character of the gain or loss? So the shareholder has stock in a corporation. So almost always, it's going to be a capital asset under Section 1221 because it's going to be an investment property. Unless it's a dealer or broker in securities, and then it'll be treated as inventory and therefore ordinary income. But almost all shareholders will be treated as a capital asset under Section 1221 and therefore capital gain or loss. If the stock is held for more than a year, long-term year or less, short term. Okay, the next issue. If the shareholder is receiving property other than cash, which we know cash always takes the basis of the face value, what is the basis that the shareholder takes? So let's say the corporation distributes in complete liquidation some land to a shareholder. We go through again the amount realized, the fair market value of the land. There's no liabilities. We don't worry about that. Minus the adjusted basis, okay, in the stock given up. That gives us our realized and recognized gain. It's going to be a capital. Let's say it's been held for more than a year. Long-term capital gain. So the next question is, what's the basis the shareholder takes in the land? This is always going to be fair market value. Fair market value under section 334. Okay? Fair market value. Without regard to any liabilities. So if there's any liabilities on the land, even if the liabilities exceed the fair market value, the basis is always going to be fair market value. Fair market value. Okay, so those are the consequences to the shareholder. What about the consequences to the corporation under the general rule, the general complete liquidation rules? Okay, the first question, how much gain or loss does the corporation realize and recognize? All right, so the general rule, for the general rule, it's getting a little, it's just like the tax code, right? We have the general rule, the exception to the general rule, all that stuff. The general rule is found under section 336, and it's going to be as if the corporation was selling it using fair market value. Okay, fair market value. All right, unless there's liabilities. And we'll talk about that in a moment. So it's going to be amount realized minus adjusted basis. The amount realized is going to be, looking at fair market value and the liability, it's going to be the greater of the fair market value or the liability attached that the shareholder is going to take, that the corporation has relief. Okay? So liability relief. Now the adjusted basis used in this calculation is going to be the adjusted basis of the property. So this says adjusted basis of the stock. This should be adjusted basis of the property. Okay, my apologies. That should be property. See, I caught myself there. You got to be careful. The adjusted basis of the property, not the stock. The stock was used for the shareholder. Property is used for the property that the corporation is giving up, is used for the corporation determining tax consequences. So the next bullet point, which I just mentioned, says that if there's liabilities to the property, liability relief to the corporation, the rule for amount realized is the greater of fair market values or the liability relief, liabilities attached. Now there's a special rule here, and this is not the second set of checklists. We'll still talk about that in a moment. The special rule says if there's a loss here and there's related parties, then the loss cannot be taken. Okay? The loss may not be recognized. The corporation may not recognize loss if there's a section 267 related party. Okay? And the distribution is not pro rata. The distribution is of disqualified property. All right? It's not a pro rata distribution. Okay, not pro rata. And the distribution, so if everybody gets the same percentage of stuff, right, then that's viewed as a pro rata. But if it isn't pro rata, right, people getting different things, then that's when this rule comes into play. Also, the distribution is of disqualified property, which I have here, any property acquired by Section 351 transaction or as a contribution to capital during the 5-year period ending on the date of distribution. The related person rules are found in Section 267. So we look at family members, we look at entities, all those different things, which I have some rules here summarized, but you can look at that, Section 267. Okay, what about the character of the gain or loss? Calculated. The character is going to be specifically looking at the specific asset that the corporation holds. So however that corporation held that asset, whether it's a Section 1231 asset, whether it's a capital asset, whatever it is. All right, final question. What about the effect of EMP? Well, in a complete liquidation, where under the general rule, all EMP is dissolved. All EMP is going to be dissolved, and therefore it's going to be gone. Okay, all going to be gone. Therefore, EMP disappears. Okay, so that is the complete liquidation general rule checklist. Now we're going to take a look at the special rule. So under the special rule, which is a non-recognition rule, you might recall non-recognition rules like Section 1031 like-kind exchanges, Section 1033 involuntary conversion, even Section 351 corporate formation. These are all non-recognition rules where gain or loss is going to be deferred. Now, this is going to be a mandatory non-recognition rule. And the idea here is a liquidation of a subsidiary. So when we have a liquidation of a subsidiary, Congress basically says, you know what? It makes sense under the non-recognition themes of liquidity issues and economics, efficiency issues, for the non-recognition rule to apply. So these are found in Section 332 and 337. 332, the actual non-recognition rule. 337 is the corresponding basis rule that defers the gain or loss, provides that neither the parent shareholder nor the liquidating subsidiary, okay, those are important. So neither the parent shareholder nor the liquidating subsidiary recognizes gain or loss. So the idea here is that we have a parent corporation that owns a subsidiary corporation, all right? And it controls, which remember, control is viewed as 80% or more, right? Greater than or equal to 80%. If we have a liquidation of the subsidiary where it no longer will exist and it's going to roll up into the parent, no gain or loss will be recognized by the parent or the subsidiary on the transaction. Now, an interesting issue, though, happens. What if you have a parent corporation and you have another shareholder, minority shareholder? Well, the minority shareholder, that will still have to recognize gain, and then the subsidiary will have to recognize gain with respect to the minority shareholder. Okay, so if we have a minority shareholder, whether it's an individual or parent, let's say they own 20% or less, that one does have to recognize gain or loss. That one does, that transaction. So what we do is we actually view the gain or loss on that part, but not this part. This part goes unrecognized, not recognized, and deferred. Okay, so going through the checklists, the first question, is there a complete liquidation pursuant to the requirements of Section 332B? So we need that complete liquidation, as we talked about. We've already actually looked at that when we looked at Section 346, complete liquidation. The next question, is there a parent-subsidiary relationship? So parent-subsidiary relationship, we just talked about that. The idea is that a parent corporation owns a subsidiary corporation, specifically 80% or more of total voting power and all outstanding stock requirements, okay, of all. So you need both of those, okay? You need 80% or more of voting, 80% or more of all outstanding stock, okay, just so you know. Now, certain non-voting preferred stock is ignored. Okay, I don't really test on the non-voting preferred, but some faculty members do, some professors do, and of course in practice you have to worry about it. So I would just focus on common, but remember, it's all voting and all classes of stock as well. So if you have non-voting and voting common. Number 3, has a complete liquidation been adopted? So again, we have to look at the complete liquidation plan. If we do have a complete liquidation, then we have to continue with the plan. We've been already focusing on that. The reason I key in on that is sometimes with a parent subsidiary, there's special relationships with what exactly is going on. And there's special rules under 332. If we meet those requirements, then we have Section 332. And again, Section 332 is going to be, we have the special checklists, which are below. If not, we apply the normal general rules for complete liquidation. All right, so the liquidation of a subsidiary, the parent corporation's tax consequences. So if we have Section 332, there's going to be no gain or loss to the parent corporation. That's under Section 332, okay? No gain or loss to the parent corporation. What's the basis of any property received by the parent corporation? That's going to be a transfer basis and tacked holding period, all tacking. So we get to roll over the basis from the subsidiary to the parent, and we get all tacking. Additional considerations. EMP, as well as any NOLs, they roll over. Okay, these all roll over. There's other tax attributes that roll over, but the main ones are any NOLs that the subsidiary had, as well as EMP. Now, by the way, if this is 100%, it's the full amount, but if it's 80%, let's say, or 90%, you're going to take the portion of that. Okay, what about the tax consequences of the minority shareholder, right? So we did an example earlier where we had parent corporation owns 80% of the voting in all classes of subsidiary corporation. And then we had minority shareholder who's, let's say it's an individual, owns 20%. So 80% here. Okay, we just talked about the consequences of the parent. 20% owned by minority shareholder. What about the consequences of minority shareholder? So to the minority shareholder, we apply the normal general rules. Any gain or loss will be recognized applying the same checklist under the general rules we just talked about, 331. So amount realized, what's received, minus adjusted basis in the stock gives us the realized gain or loss that will be recognized by the minority shareholder. What basis is taken by the property? It's going to be the fair market value basis under 334, again, under the general rules, just like we saw. And again, E&P, that's not an issue. That goes away in that situation. All right, the liquidating subsidiary. So let's think about the situation here with the parent in the subsidiary and minority in the subsidiary corporation. So with respect to the liquidating subsidiary, how much gain or loss is recognized? So in determining the gain or loss recognized, the consequences need to be broken up. And the idea is that the gain or loss with respect to this transaction to the subsidiary will not be recognized. But the gain or loss on this transaction will be recognized, both to the minority and to the subsidiary corporation. So we have to break up the transaction. So what's the effect of the complete liquidation distribution to the parent with respect to the minority? That's going to be no gain or loss. No gain or loss. So if we have a transaction where it's just the parent subsidiary, parent owns 100%, no gain or loss recognized to parent, no gain or loss recognized to subsidiary. But we don't have that. We have partial no gain or loss recognition, but then this side we have gain or loss recognition. So the consequences with respect to breaking it up to the parent, no gain or loss. What about if the subsidiary owes a debt to its parent? Then any property that's subject to the debt is treated as a distribution subject to the general non-recognition rules. That's with respect to liabilities and debts. What about the effects? That's the one part. That is the parent to the subsidiary, and that's the 80%. What about the minority shareholder to the subsidiary where we have the 20%? 20%. So and with respect to that transaction, the subsidiary must recognize the gain or loss under Section 336. So the liquidating subsidiary corporation, so liquidating subsidiary recognizes gain or loss with respect to this part. So not here, but here. Here it does. So we have to look at the consequences just with respect to that transaction. So any assets transferred to the minority shareholder, you look at any gain or loss with respect to that. However, liquidating subsidiary does not recognize a loss, never a loss on the transaction. Never a loss. And that's because of an anti-abuse rule. This is very important. So in this transaction, only gain. Only subsidiary can recognize gain, but not loss when you're dealing with the minority shareholder. Never a loss. Okay? Not loss. If it's a loss, it's going to be anti-abuse rule and the loss is not going to be recognized. What's the character of any gain recognized? It's going to be looking at the specific asset, just like we saw in the other, in the general checklist. So we look at the specific asset. All right, so that finishes up the subsidiary liquidation special rule, and we've completed all the checklists now for all the different complete liquidations. So I hope you've enjoyed this video. Now it's important to go practice some problems.